Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, December 8th, 2023. This morning, we learned that the unemployment rate fell in November after rising over the previous 3 months. November's unemployment rate of 3.7% is not only lower than October's reading at 3.9%, but also lower than the 3.8% rate recorded in August and September. So I have the report pulled up for you here. If you go down to about the 7th or 8th line down, which says unemployment rate, you'll see in November of a year ago, it was 3.6%. And then it skips forward to September at 3.8, October 3.9, November 3.7. So really, it's flat. And if you look at a lot of these other numbers closely, they haven't changed much either. The unemployment rate in this country and a lot of the numbers for specific groups have really stabilized quite a bit during the past year. So that's perceived to be more good news than bad, although again the Fed is trying to dampen demand for retail goods to drive down inflation. But it doesn't look like, you think about how much interest rates have gone up over the past year, and the unemployment situation has changed hardly at all. At the same time, total non-farm jobs increased by 199,000 in November, which was a bit higher than the 185,000 expected. Also, wages grew by 0.4% last month and 4.1% during the past year. Both of those figures were slightly higher than anticipated too. The stock market shook off those numbers in part due to the Job Openings and Labor Turnover Survey, or JOLTS, report released earlier this week that showed the number of job openings per unemployed job seekers fell to 1.34 in October. That is its lowest level since August, and suggests that employers will not have to bid up wages as much to attract workers, which in turn should dampen inflationary pressure on retail prices. So the more job openings there are per unemployed worker, the idea is that employers are bidding against each one another to attract those workers. So when that ratio goes down, as it did last month, workers don't have to pay quite as much to attract people to come to work for them. Now, a few months ago, when pessimism was driving the stock market lower, Wall Street might have flinched at this morning's jobs report. But now that cautious optimism is the prevailing mood on Wall Street, that news had no discernible impact on stock prices. This afternoon, all the major stock market indices were higher. You see the S&P 500, and this is around 2:30 in the afternoon. It's up almost 0.4%. Dow, a little less than that. NASDAQ, a little more. Small cap stocks up almost 0.5%. So Wall Street clearly didn't perceive much risk in the numbers that came out this morning. In fact, there's a growing belief on Wall Street that oil prices will continue to fall in 2024. Certainly the Biden administration would like to see energy prices continue to fall heading into next year's general election. That would go a long way towards appeasing voters who've grown weary of high gasoline prices. Since peaking near $95 a barrel in late September, the price of crude oil fell below $70 this week. And here I'll show you a chart of price of oil, and you can see it peaking here back in late September. But since then, just a steady decline, some up and down motion, but definitely a downward trend here. In addition, some analysts are predicting an oil price war waged by Saudi Arabia soon to gain market share so it can raise prices later. The last time that happened was in 2020, when the price of crude oil fell precipitously and the major oil producers suffered huge losses. However, remember, that happened right at the same time, and in fact it happened because of the COVID-19 outbreak. OPEC smelled an opportunity. They knew demand for gasoline would drop when for a while there nobody could drive into work or drive to stores. So there was a lot less gasoline being consumed, and Saudi Arabia's strategy was to drive down the price of oil so much that that their competitors, i.e. the major super oil producers, Exxon, Mobil, Chevron, etc., would take huge losses. And they did take huge losses, but they bounced back quickly. So I don't know if Saudi Arabia and the rest of OPEC is going to be quite as eager to do that now when we don't have something like COVID lessening demand. In fact, demand for energy continues to go up. But bear in mind, a big drop in energy prices would also go a long way towards driving down inflation. That's because higher energy costs get passed on to consumers in the retail prices they pay for goods that must be sourced, transported, and stored using energy. To be sure, there's no proof of this theory yet. In fact, as my colleague Robert Raper recently explained, and I'm showing you the article here from December 5th, and you can see this on the Investing Daily homepage, Profiting from OPEC's Moves. Saudi Arabia and the rest of OPEC countries have agreed to cut production by an additional 1 million barrels per day next month. So far, domestic oil producers, especially those operating in the Permian Basin, have been able to more than offset OPEC's production cuts to prevent oil prices from going higher. In other words, the price of oil may not rise next year regardless of what OPEC does. If they produce less, we'll produce more. And if they produce more, we'll produce less. Either way, the American consumer wins. That's this week's PF Update, and I look forward to talking to you next week.